In a rapidly evolving landscape, cryptocurrency continues to capture the attention of investors and the broader financial community. As digital assets gain traction, the need for a rational approach to investing in this volatile market becomes increasingly vital. In a recent article for Fortune, Jeff John Roberts offers a comprehensive guide aimed at helping both casual and seasoned investors navigate the complexities of cryptocurrency. Roberts highlights the dual-edged nature of the crypto market, where the allure of exceptional returns is often countered by significant risks, including rampant scams and extreme price volatility. For instance, Bitcoin, the largest cryptocurrency, has shown remarkable growth over the past decade, climbing from just $325 in early 2015 to a staggering $109,000 at its peak earlier this year. Yet this meteoric rise has been marred by multiple crashes, with the market experiencing declines of over 80% at various points. Despite Bitcoin's repeated and spectacular crashes, its floor keeps rising. Roberts notes, emphasizing that each downturn has reset the market's base price higher. Even with recent recession fears impacting prices, Bitcoin remained robust, trading above $80,000 as of mid-March 2025. To mitigate the inherent risks of crypto investing, David Pakman, a partner at CoinFund, advocates for a blue-chip strategy. This approach involves creating a diversified portfolio, allocating 60% to Bitcoin, 10 to 15% to Ethereum, and the remainder to a selection of other established cryptocurrencies such as Solana, Uniswap, and Aave. What I suggest is a blue-chip strategy, Pakman states, underscoring the importance of selecting cryptocurrencies backed by strong narratives and real-world utility. The narratives surrounding these digital assets are crucial for understanding their potential longevity. Bitcoin is often viewed as digital gold, a hedge against inflation and government overreach, while Ethereum serves as a versatile platform for decentralized applications through smart contracts. Emerging players like Solana aim to enhance transaction speeds and efficiency, making them attractive alternatives in the blockchain ecosystem. However, the crypto landscape is not without its pitfalls. Roberts warns potential investors to remain vigilant against the myriad of scams and speculative ventures that can lead to significant losses. He advises conducting thorough research into a cryptocurrency's purpose and the integrity of its development community before making any investments. Furthermore, adopting a strategy of dollar-cost averaging, investing fixed amounts over time, can help reduce exposure to market volatility. In a positive development for retail investors, major asset managers like BlackRock are now offering cryptocurrency exchange-traded funds (ETFs), making it easier to gain exposure to digital assets through traditional brokerage platforms. While these ETFs come with management fees, they provide a more structured and regulated entry point into the crypto market, potentially enhancing investor confidence. Amidst these developments, the political landscape surrounding cryptocurrency regulation is also shifting. Paul Atkins, President Trump's nominee to lead the Securities and Exchange Commission (SEC), is expected to advocate for clearer regulatory frameworks that encourage innovation while minimizing hindrances on the market. His forthcoming testimony before the Senate is highly anticipated as stakeholders await insights into how he plans to navigate the regulatory environment for digital assets. Furthermore, companies like Spirit Blockchain Capital are innovating in the crypto space with the recent launch of their Ethereum and Solana exchange-traded products (ETPs). This move signifies a growing trend towards integrating traditional finance with blockchain technology, enhancing accessibility and liquidity for investors. As the cryptocurrency market continues to mature, it presents both opportunities and challenges. For investors, understanding the landscape, developing sound strategies, and staying informed about regulatory changes will be crucial in navigating the complexities of this dynamic environment. As new products and regulatory frameworks emerge, the future of crypto investing holds promise, provided that investors remain cautious and well-informed. GameStop's recent announcement to raise $1.3 billion through convertible senior notes to invest in Bitcoin has sent ripples through the stock and cryptocurrency markets. Following the news, GameStop's stock GME plummeted by more than 6% in pre-market trading, demonstrating the volatility and uncertainty that often accompany significant corporate shifts, especially in a company that has transformed into a meme stock phenomenon. The announcement came on the heels of a notable increase in GameStop's shares, which had risen nearly 12% after the company declared an update to its investment policy to incorporate Bitcoin as a treasury reserve asset. This strategic pivot towards cryptocurrency follows months of speculation regarding GameStop's potential interest in the digital currency sector, particularly after CEO Ryan Cohen's cryptic social media interactions that hinted at a relationship with cryptocurrency leaders. Despite the enthusiasm surrounding Bitcoin's potential, analysts remain skeptical about the effectiveness of GameStop's strategy. Michael Pachter, a managing director at Wedbush, expressed concerns, noting the company's strategy, which has changed about 6 times in 3 years, is they're going to buy cryptocurrency and be just like MicroStrategy. He cautioned that aligning with MicroStrategy, a firm renowned for its substantial Bitcoin holdings, may not translate to success for GameStop, especially when considering that MicroStrategy trades at about twice the value of its Bitcoin assets. GameStop's recent financial performance adds another layer of complexity to the narrative. The company reported a 28% decline in net sales for the fourth quarter compared to the previous year, with total net sales of $1.28 billion. This downward trend raises questions about the firm's ability to successfully pivot towards a volatile asset like Bitcoin, particularly when it has yet to deploy its significant cash reserves, which have ballooned to $4.8 billion. In the broader cryptocurrency context, Bitcoin itself is experiencing a resurgence, trading at approximately $87,243, with predictions that it could reach $100,000 by the end of 2025. Market analysis suggests that Bitcoin could experience a 60% increase from its current price, driven by recovering investor confidence as macroeconomic uncertainties, including trade tariffs, begin to stabilize. Polymarket, a prediction platform, indicates a potential price ceiling for Bitcoin at $138,000, marking an optimistic outlook for the digital currency. As Bitcoin's price hovers around critical resistance levels, analysts are closely monitoring its movements. A breakout above $88,000 could signal a significant rally, potentially pushing the cryptocurrency towards its all-time high. However, failure to maintain support at $85,000 could result in a pullback to the yearly average of $76,000, a level deemed crucial for sustaining bullish momentum. In conclusion, while GameStop's venture into Bitcoin could potentially align it with a rapidly evolving financial landscape, the company's inconsistent strategy and recent financial performance may hinder its success. The cryptocurrency market, on the other hand, appears to be on a cautious rebound, with analysts projecting a path towards 6-figure valuations for Bitcoin in the coming years. As both GameStop and Bitcoin navigate their respective challenges and opportunities, it will be crucial for investors to remain vigilant, watching key price levels and corporate developments that could shape the future of this tumultuous yet exciting market. In a striking development within the cryptocurrency landscape, the Trump family's venture into digital assets is poised for a significant expansion, with the announcement of a new dollar-backed stablecoin, $1. This stablecoin, linked at a 1-to-1 ratio to the US dollar, is being touted as a key player for institutional investors looking to navigate the volatile waters of cryptocurrency. The firm behind this initiative, World Liberty Financial, co-founded by Donald Trump and his sons, aims to provide a secure alternative for cross-border transactions, as stated by co-founder Zach Witkoff. The launch of $1 comes at a time of increasing regulatory focus on stablecoins, which have emerged as one of the fastest-growing segments in the cryptocurrency market due to their stability compared to more volatile digital assets like Bitcoin. Witkoff emphasized the potential of the digital dollar, stating, "We're offering a digital dollar stablecoin that sovereign investors and major institutions can confidently integrate into their strategies for seamless, secure cross-border transactions." However, this expansion raises ethical concerns regarding potential conflicts of interest. Critics argue that Trump's involvement in the cryptocurrency space, particularly as a public officeholder, blurs the lines between business and governance. Trump previously launched a meme coin that briefly surged in popularity before experiencing a prolonged decline, demonstrating the unpredictable nature of such speculative assets. His endorsement of various crypto projects, including a partnership with Crypto.com to create exchange-traded funds focused on cryptocurrencies, has sparked debate over whether his actions are appropriate for someone in his position. The timing of these developments coincides with a broader national conversation about the regulation of cryptocurrencies. Following the announcement of $1, Congress is pushing for legislation aimed at providing clearer guidelines for stablecoin operations in the U.S. This regulatory momentum is indicative of the growing recognition of cryptocurrencies as not only a financial tool but also a significant component of the economy. Moreover, Trump's recent activity in the cryptocurrency domain reflects a notable shift from his earlier skepticism towards digital assets. He has expressed intentions to position the U.S. as the world capital for cryptocurrencies, aligning with the interests of a sector that heavily invested in his political campaigns. This pivot is further highlighted by the structure of World Liberty Financial, which allows for a Trump-owned company to receive 75% of the net revenues, raising questions about the potential for personal gain from these initiatives. As the cryptocurrency market continues to evolve, the implications of Trump's ventures into this space will likely resonate beyond his personal wealth. They could shape the regulatory framework surrounding digital currencies, particularly as lawmakers seek to address the risks associated with stablecoins and the burgeoning crypto economy. With the U.S. Senate Banking Committee set to hold hearings on crypto regulation and the nomination of industry-aligned candidates, the intersection of politics and cryptocurrency is becoming increasingly complex. Looking ahead, the developments surrounding $1 and Trump's ongoing influence in the crypto sphere will warrant close scrutiny. As the market braces for potential regulatory changes and the launch of new financial products tied to cryptocurrencies, the ramifications for both investors and policymakers could be profound. The future trajectory of Trump's crypto endeavors may not only impact his personal fortunes but also the broader landscape of digital finance in America. As the cryptocurrency market continues to experience volatility, investors are left contemplating whether to buy and hold established assets like Bitcoin and Ethereum or to explore alternative opportunities within the space. With Bitcoin hovering around $86,817 and Ethereum at approximately $2,019, the question of which asset might yield better long-term returns is more relevant than ever. Recent analyses and expert opinions suggest that while both cryptocurrencies have their merits, the decision ultimately hinges on individual risk tolerance and investment strategy. Bitcoin, often heralded as the digital gold, has seen an astonishing increase of nearly 35,000% over the past decade. Its market dominance, currently accounting for about 60% of the total crypto market cap, offers a level of stability that many investors seek, especially during turbulent times. Notably, Bitcoin has consistently rebounded from past market crashes, and experts like Cathie Wood of ARK Invest predict that it could reach an eye-watering $1.5 million by 2030. This optimism is grounded in Bitcoin's potential roles as a store of value and a medium of exchange, particularly in developing economies. On the other hand, Ethereum made history as the first cryptocurrency to implement smart contracts, which transformed blockchain technology from a simple ledger into a versatile ecosystem. This innovation allows for the creation of decentralized applications, dApps, and non-fungible tokens (NFTs), which have gained traction across various industries. Despite facing competition from faster and cheaper smart contract platforms, Ethereum remains dominant, holding over 50% of the total value locked in decentralized finance DeFi protocols. The introduction of Layer 2 solutions, which alleviate network congestion, further strengthens its position in the market. However, the ongoing market fluctuations have prompted discussions about the broader implications for all cryptocurrencies. In March alone, the overall crypto market cap plummeted by over 30%, stirring fears among investors. Yet as prices begin to recover, many are grappling with the notion of buying the dip. While the allure of smaller, lesser-known cryptocurrencies is tempting due to their potential for massive gains, the risks associated with these investments are considerably higher. With over 13 million cryptocurrencies in existence, the likelihood of picking a winner is often based on a mix of luck and extensive research. Analysts recommend a cautious approach during market downturns, favoring established cryptocurrencies like Bitcoin and Ethereum. These assets not only have a proven track record of recovery but also stand a better chance of achieving new highs in the long run. For investors contemplating their portfolio allocations, it is crucial to assess their risk tolerance and set realistic expectations regarding potential losses and gains. As the cryptocurrency landscape evolves, the future remains uncertain. Ripple's CEO recently issued a bold trillion-dollar prediction emphasizing the potential for major shifts in valuations across the crypto space. Such predictions, while ambitious, underscore the transformative potential of blockchain technology and its applications. Investors must stay informed, adapting their strategies in response to market dynamics, regulatory changes, and technological advancements. In conclusion, whether one chooses to invest in Bitcoin, Ethereum, or other emerging cryptocurrencies, the key takeaway is the importance of informed decision-making based on individual investment goals and risk appetite. As the crypto market continues to mature, the coming months will likely reveal new opportunities, making it imperative for investors to remain vigilant and adaptable in their pursuit of wealth in this volatile yet promising sector. In a landscape where cryptocurrencies have become increasingly appealing to institutional investors, recent findings from a Coinbase survey shed light on a notable trend. Solana, SOL, and XRP are gaining traction as preferred digital assets. As the cryptocurrency market continues to evolve, these two coins have emerged as potential strongholds among institutional portfolios, reflecting a significant shift in investment strategies aimed at capturing the growing digital asset market. The Coinbase survey, conducted in January among 352 leaders from institutional investment organizations, of which 86% manage over $1 billion in assets, revealed that 83% of participants plan to increase their digital asset holdings in 2025. This bullish sentiment is particularly promising for Solana and XRP, with 34% and 30% of respondents respectively already holding these assets. The implications of such commitment are substantial, as institutional investors increasingly allocate their capital to cryptocurrencies. The anticipated approval of exchange-traded funds (ETFs) that include these assets could further drive demand. Investors are clearly signaling their confidence in cryptocurrencies, particularly in established players like Solana and XRP, stated Alex Carchidi, a financial analyst. With the potential for ETFs to be approved soon, we could see a significant uptick in institutional buying, which historically correlates with price increases. The anticipated influx of capital from institutional investors could create a robust tailwind for both coins, positioning them favorably for growth. As of March 27, 2025, Solana is valued at approximately $137.53 with a market cap of $70 billion, while XRP stands at $2.34, boasting a market cap of $136 billion. Despite recent declines of 5.06% and 4.66% respectively, the underlying fundamentals suggest that these assets are becoming increasingly attractive to a larger pool of investors. However, it is essential to note that investing in cryptocurrencies remains inherently risky. These assets can be highly volatile and investors should approach them with caution, Carchidi advised. A diversified portfolio is crucial, and crypto should only occupy a small portion of one's overall investment strategy. This renewed interest in Solana and XRP comes at a time when the broader cryptocurrency market is witnessing a revival in meme coins as well. The launch of the Solana-based meme coin Morning Routine has captivated traders, reaching a market cap of $19 million shortly after its debut. Inspired by a viral video from fitness influencer Ashton Hall, the coin exemplifies the unpredictable nature of meme-based cryptocurrency investments. The phenomenon has led to an uptick in activity across various meme coins, indicating a potential shift in market dynamics. In addition to individual investments in cryptocurrencies, platforms like Pump.Fun are exploring new avenues for funding scientific research through decentralized means, further demonstrating the innovative spirit of the cryptocurrency community. As the market adapts and evolves, it seems poised for further developments that could redefine investment strategies and asset allocations. In conclusion, while Solana and XRP are emerging as increasingly attractive options for institutional investors, the cryptocurrency landscape remains fraught with volatility and risk. As institutional interest grows, these assets could experience significant price movements driven by supply and demand dynamics. Investors should remain informed and prudent in their approaches, recognizing the potential for both opportunity and risk as the market continues to mature. The coming months will be pivotal in determining how these trends will unfold, and the cryptocurrency community will be watching closely for any signs of further institutional engagement.